Look at this incredible view, and greetings from the land of the rising sun. This is Japan, Niseko, Japan, and what a gorgeous, gorgeous view. So we got about 4 inches of fresh powder last night and are hitting the slopes here in a few minutes. But since I am in the land of the rising sun, and our guest today is going to talk a lot about demographics, and I disagree with him, not in concept, just in timing on this. But demographics. Japan is one of the most interesting countries to study demographics, actually demographic collapse. As you know, the replacement rate, if you want to sustain a population level, is 2.1 children per woman, 2.1 per woman. And Japan, I don't have it offhand, but I believe their replacement rate is less than 1. So this is a country that will literally no longer exist in 70 years. Isn't that a scary, scary thought? As I always say, if you want to have a country, you must have children. And the demographics affecting many countries around the world and many regions around the world. Russia, of course, China with their one-child policy, huge demographic disaster. You're going to start seeing the effects of that in about 6 years or so in a major way when there's not enough young people to sustain the population of older people. And of course, Western Europe and the US also, but the big difference with the United States is it's very friendly to immigration. So with that friendly immigration policy, it is replacing its population not through the typical Euro-American birth rate, but through immigration. And in Japan, a country that is so polite and people are so wonderful, it is just really sad to see that this country will literally no longer exist in decades to come. I mean, they're not open to immigration. They don't have children. You've heard me talk about the very interesting phenomenon of Japanese women marrying themselves. Yes, I'm not kidding. Remember when Dennis Rodman did that in the 90s as a publicity stunt? Well, Japanese women wanting to have a wedding ceremony with no husband. Yes, that is just amazing. Look it up if you want more on it. It's absolutely incredible. But let's get to our guest, Neal Bawa. He'll be with us today and again on the next episode because this was a long, long interview. And we got into a bunch of really great topics about the real estate market, about predicting the market, but especially population. And in this interview, he talks about, and this is so fitting being in Japan that we're doing this interview today, but in this interview, he talks about the demographics affecting the real estate market and how they will start to really change the real estate market. And I do agree with him in concept. I just think that his timing is way too soon. That effect is going to be seen in about 2045 to 2050, where we will have to have an entirely new strategy by then. But until then, keep on investing because we are investing in the most historically proven asset class in the entire world. Thank you again to all of you who came out to Empowered Investor Live. We will have the recordings in about 1 week. Our video editor tells us about 1 week away from having really nicely organized recordings for you. So those are coming up. So if you purchase those recordings, stay tuned for that. And then thanks again to all of you who joined our Empowered Mentoring program as well. As soon as I get back, that will continue with me. But in the meantime, we have an important guest for our next session, and you should have all received an email on that. My friend Patrick will be doing that session and talking about the mindset of success. And he does a great job with that. So let's go ahead and get to the first part of our interview with Neal. I think you'll find this to be very, very interesting. And if you are listening on audio only, be sure to check out the video of this on YouTube because this view behind me is absolutely spectacular. You've just got to see it. Tune into the YouTube video just for the view, if nothing else. It's absolutely amazing. All right, here is the interview with Neal. It is my pleasure to welcome Neal Bawa to the show. He is known as the mad scientist of multifamily. He's a technologist, a data scientist, and a real estate investor. Neal, welcome. How are you?
Great. Thanks for having me on the show, Jason.
It's good to have you. So, you've dealt with a lot of things in your career. You really went down the rabbit hole and looked at blockchain for fractionalizing real estate,
Yeah.
which is something that, we've done many shows over the years on that. And it just doesn't seem to be quite coming to pass, does it? Maybe we'll kind of start with that.
Yeah, I think that, I'm holding at any given point of time, $750 million in real estate. And one of the questions that I had was, with real estate, when you build a real estate company, the value is in the real estate itself. So when a property sells, you make profits, and nothing wrong with that. But it doesn't have the multiples that you have with technology companies. So at some point, I was like, well, perhaps I could convince my investors to fractionalize some of my assets and build a company that could have technology level multiples, 10x, 100x, whatever it might be. So I spent a significant amount, portion of a year investigating blockchain, and I'm fond of crypto and blockchain and what they meant to represent when they started out. I think it's been warped beyond what it was. Money tends to warp everything. But I looked at it and I said, can I use the blockchain to fractionalize real estate? Because what you think about it, real estate is the largest asset class in the world. It's bigger than all stock markets combined, 300, trillion dollars. But it is also the most illiquid asset class simply because there's no way to sell real estate like stock. And I looked into it and I said, what if there was a way to take commercial real estate, single family real estate, and basically sell it like stock and use the blockchain, and the blockchain basically gives it that credibility, that nobody's selling the same building 10 times over, things like that. The truth is, when I looked into it, the current companies that are trying to take real estate and turn it into blockchain packets, tickets, whatever you want to call them, tokens, um, are nowhere near the point where this can be really commercialized. I mean, it's the equivalent of solar in the 1990s. I mean, it took solar until 2010 to become financially viable. Before that, all green people were doing it. And I think that's where we are with this. But what is even worse is that the legality of doing it, the way that it makes sense to do it, financially makes sense to do it, is clearly in a very gray area. And not only that, the collapse of the crypto infrastructure,
Right.
followed by the scandals of FTX and others, means that recently the SEC has issued guidelines taking it from a gray zone basically into a black zone.
Right.
So I backed away because I could not find a way to make it either financially viable or legally viable.
Sure, sure. And well, not just would fractionalizing it be nice, but also it just would, and making it tradable, but it would lower the barrier to entry. I mean, imagine if someday, if it does work out, if you could sell a $100 share of a house or an apartment complex to someone in Uganda, right? Like that would be really cool if just tons of people could have shares, small micro shares, like they can have a coin or a token, like they can have
That's
a
the
piece, a
vision.
slice of Bitcoin, right?
Yeah, I couldn't have articulated it better. That is the vision. If I can go to a party and somebody gives me a stock tip, I fish out my phone, I tap on E-Trade or Robinhood, and I buy it 5 seconds later. Why
Mhm.
can't I do that for real estate? And the truth is, because every real estate property is so different from every other property, and there's no benchmark. There's no
Yeah,
organizations in the background rating companies like
right.
Moody's or S&P 500. That process, I believe, will take decades.
Yeah. And just as an aside, not that we can trust Moody's, because we all know what they did during the rating scandal of the Great Recession, right? But yeah, I get the idea. Sure. Absolutely. Well, share with us a little bit about your outlook on the economy, the real estate market. I mean, if you ask me, the Fed has just screwed this up so badly. They waited way too long to raise and tighten, and now they've done it far too suddenly, and it's a shock to the system. They just should have tightened sooner, more gradually. That's my opinion. Feel free to differ, but what do you think? Where do you think the economy is going to? I'm sure you probably think we're going to enter an official recession this year, a declared recession finally.
Yeah, so I mean, I'm not going to play shoulda, coulda, woulda games. The Fed's job is actually not as simple because the everything that the Fed does has a time lag. So
Yeah.
the Fed has to basically make guesses based on where the economy will be 6 to 9 months from now. just because they're the Fed doesn't mean that they're better at guessing than you are or I am, right? So
Yeah.
it's problematic for them. But here's where we stand today, right? So on the one side, we have a bipolar economy of the sort that I've never seen before. Not
Yep.
once. I
I
haven't seen it
agree.
in 2020. I haven't seen it in 2009. In 2009, clearly the economy was in the shitter. Everyone agreed on that. Today we have one set of economists pointing out to the fact that in December the economy produced 233,000 jobs, which is a wonderful number at any given point of time. But it is a truly astonishing, out of this world number when the Federal Reserve is taking a howitzer to the economy. They're basically every 4 or 5 weeks bombing the US economy. And they've
Right.
done it now 1, 2, 3, 4, 5, 6, 7 times in 7 months, which is by far the fastest pace in history. They've never actually done this kind of raises in 7 months in their entire history. And they've been forced to do that, as you mentioned, because of the catch up. And so, as they're bombing the economy is actually fighting or resisting the what the Fed is doing in a way that is truly extraordinary. This has never happened before in history. You
In
can
other
go
words,
back
the
all the
economy
way,
is keeping the unemployment rate pretty low despite
shockingly low,
all of the Fed's
shockingly low, right?
measures, and the Fed is
Exactly.
trying to make unemployment go up.
Exactly. So here's the Federal Reserve. It starts doing this a year ago when unemployment was 3.5.
Right.
On December 31st, unemployment is 3.5.
Yeah.
So they've moved exactly 0 percentage points from where they were after 12 months of heavy bombing,
Yeah.
which
Damn, the
essentially,
Phillips curve doesn't care, you know?
exactly. I mean, in the past, there were always these people saying, yeah, but these are not real jobs. There's a lot of part-time jobs and wage growth is low. Wage growth is astonishing. Wage growth is 5.6%. That's triple what it used to be
Yeah.
3 years ago. So the economy is growing. Wage growth is very strong. Labor participation is down. So that's the one downer, but it's really difficult to bring 2 or 3 million people back into the workforce that are getting older. And labor force participation is a worldwide problem. We actually are the best in the world at it. China's the worst at this point. Japan's pretty bad. So labor force participation is a long-term problem. It's there's no short-term fix for it. So what does this do to real estate? Well, the truth is we had an absolutely astonishing run between March, 2020 and let's say July or August of this year. Home prices went up 34%. I mean, that makes no sense, right? Why would home prices go up 34%? So now we're in this retrenchment period where, depending upon the markets, we've already seen retrenchment. So the three markets in the US that have retrenched the most are Coeur d'Alene, very small market in Idaho, Austin, kind of biggest boom town in America, and San Jose, biggest, that's Silicon Valley. So those have retrenched by 10.6% each. And then there's other boom towns like Phoenix and Denver that are sort of
And don't
heading in that
forget
direction.
Boise.
Boise, right? So Boise
That's been a
obviously was
poster
the
child. Yeah.
kind of a poster child of a boom town, and they're not down 10% yet, but they're heading in that direction, with Coeur d'Alene being in the same state. So we're seeing that correction occur, and I'm seeing this fear of that correction as if the world is ending. And what I want to point out, Jason, is that if the entire real estate market in the US corrected by 15%, we would still be up a shocking number
Yeah.
from March 2020. So retrenchment and correction is normal and should be factored into, because if you don't correct, then you end up in a everything bubble, which then bursts and then takes everything down for 4 or 5 years, like it did from between 2008 and 2013. So we're in that correction process. Multifamily is already corrected by 8 to 12%. Real estate, not so much. I mean, nationwide, it's only corrected about 3.5%. But what I'm seeing, which is good, is that the most bullish markets, the ones that exploded the most, are higher than that number. So they are 6, 7, 8, 10%, and I think that they go another 5, 6, 7%. There could be markets in the US that correct to 20%. Like, I'll give you an example. Austin went up 72%, so if it corrects by 20%, it's still at 52% in 2 years.
Yeah. Right.
What's wrong with that?
Yeah. Yeah. I mean, look, folks, did anybody in these cyclical boom markets really think that they were going to get to keep all of that appreciation? It's just ridiculous. You're just not going to keep all of that gain. It's more than you deserved. So give a little back, and let's not be too greedy here. But, just back to the Powell thing for a moment in the Fed, okay, which you started with. I know you don't want to play coulda, shoulda, woulda, but, and the Fed does have a lag to what they do. Obviously, we get it. But all of that time that Powell kept saying it's transitory, and everybody kept telling him, no, it's not transitory. He tried to blame it on the supply chain. And that was partly true, but they took a $4 trillion problem and pumped what, 16 trillion in, right? It's just they overdid it. And when you have the lowest interest rates in, according to David Graeber's book, Debt the First 5,000 Years, the lowest interest rates in 5,000 years. You've got to believe you're going to create an inflation problem there, right?
Yeah, and I think that what you mentioned had a lot to do with it, but I want you to keep this in mind. During COVID, the country that printed the most, whether you want to call it quantitative easing or
Yeah,
actual money
right,
dropping, where you
right.
give money to people, either
Helicopter
one of
money.
those,
Yeah,
helicopter money, we did it the most. A few other countries did it.
yeah,
But please note that inflation is a worldwide problem.
sure.
And inflation is, if you take a collection of 30 countries that did no money printing, their inflation would be higher than the United States. So our inflation, briefly went up into the nines. But today, the inflation worldwide, if you just take the United States out, is over 10%. And most of these countries didn't print. So I firmly believe that supply chain played a massive role in this process. And just as supply chain was adjusting, just as the Fed was going to get a break, the Russian war started and hiked oil up to 130. So
Yeah,
I feel like I have to cut some slack to the Fed
that's true.
because the Fed could not have predicted oil going up $50 a barrel.
Yeah, the Russian invasion definitely was a huge impact on that. There's no question about it. But, those other countries don't have the reserve currency. So the US has the opportunity to make its inflation rate lower. Let's assume, of course, we probably both believe that the measurements are highly manipulated. I
They are.
certainly do. But let's assume they all manipulate the same way, right? For sake of discussion.
Other
It's
countries manipulate too. Yeah,
Yeah,
yep.
of course, of course. And so let's assume they're all understating their inflation rate, but the US, with the reserve currency status and the ability to import deflation to offset its inflation, really has a benefit by opening up the southern border and also importing cheap products from, of course, China and the others. So
No doubt, Jason.
the
And
US is in a very
yeah.
good position. I mean,
We're in an
yeah.
absolutely spectacular
Oh, yeah,
position.
it's
I
incredible.
often read stuff about the US is screwed, which makes me chuckle. It makes me laugh because
Oh, they're
if
crazy.
we are
Yeah,
screwed, then there are no countries in the world that aren't screwed
yeah,
because we lead a world order that has us at the very center of it. And it's not just that we're the center, we're the foundation itself of that
yeah.
world order. So, and the foundations of anything crumble last. So I think, problems always begin at the periphery, and we're seeing those problems in places
Yeah,
like Sri Lanka and Pakistan that are basically falling apart.
right.
But I want to go back to something that you said that I think is very important to me. I am not in any way suggesting that what we did was right. I think it was extremely foolish. I think that the Fed should have closed the tap sooner on their side. The Fed really does not control what the politicians do, so that was joint foolhardiness. Keep in mind that most of the money passing bills didn't pass by one vote, so Republicans and Democrats voted together.
Of
So I
course.
think it
Yeah.
was extremely foolhardy. What I wanted to point out though was this was an instance where supply chain screwed every country in the world,
Oh,
including us.
yeah, no question. I mean, the supply chain, and especially look at the construction materials, the
Oh my God.
lumber specifically,
Yeah. I mean,
during
lumber's a
during a
perfect
time when it
example
was,
because I have projects that were hurt very badly by it. So lumber is, or per 1,000 square feet of lumber was at 400 before COVID. Uh, stayed up around 1,200, so 3x, that's 300% in a
right,
year, and then went down to 1,200, floated around there for a while, and then and people are like, no, no, this is forever, it's never going to come back down. Today, the price of lumber is lower than it was the day before COVID.
right,
Lower.
yeah.
It's lower than, $400. So all of that inflation was because of supply chain. There was nothing else there except for gouging and supply chain.
Yeah. So, since we are talking about construction materials, another thing that's interesting, and I've done quite a few shows on this where I've discussed this concept, and that is that, of course, real estate is a very low tech asset class. In
Mhm.
other words, it's unlikely to be disrupted by some major innovation. I mean, unless we're all going to start living in force fields, I guess, we're going to have sticks and bricks pretty much. And of course, they talk about 3D printing. So far as I can tell, that's just total hype. I've I've done shows on that too,
Well, I
investigated
wouldn't
that
call it
deeply.
hype. I just feel like this is just like the EVs, right? So we were supposed to have self-driving cars in 2016,
Right.
2018,
Yep.
2020, and 2022.
Yep.
I'm not saying that we will never have self-driving cars.
No.
I think we've made tremendous progress in the last 8 years. But by its very nature, because technology requires a very large amount of capital, they're constantly lying. So every company that's in that business lies about the amount of time that it will take, and crypto companies were no different. And that's why they saw an 80, 90% decline in valuation. The truth is, I think 3D printing is the future of real estate. But is it the future of this decade? God, no, they're so far. Right now, the cost of a 3D printed home is significantly higher than the cost of a normally printed home. All right. Solar, for example, 2010 was 10 times more expensive on a per kilowatt hour basis than it is in 2022. Right?
Hmm.
And we've had solar since the 1990s. So it took a long time to get to the point where the supply chain was built out enough to make it cheap. And I think that to think that we are going to have a substantial impact on the housing stock in this decade from 3D printing is just nonsensical. But I wouldn't bet against it happening next decade.
Okay, so here's the thing. The technology of 3D printing is really interesting. I mean, very little waste compared to traditional construction, which is lots of waste. We've all seen the dumpsters out in front of the houses they're building, right? And remodeling. And that's all good and it's fast. And, one of the problems we have is that the aging workforce of construction workers. I mean, these construction workers are not guys in their 20s anymore. The average construction worker is like 54 years old now. It's insane how old these guys are working on these construction sites. Just go out and look for yourself. You don't have to take my word for it. But the thing about 3D printing is not the tool that builds it or the technology that designs it. It's that it's all made of atoms. Okay. And the material is a concrete composite type mixture most of the time. And that costs money. I mean, there are wars over sand because sand is the ingredient to concrete. And so, until there's some breakthrough in materials science, right? I don't know. We can make homes in the future out of graphene. Who knows? Who knows? That's the problem. It's the material, right? The 3D printer will make construction more efficient. It requires, like a couple of workers instead of a whole crew. That's all great. So you cut down on labor cost, but it still requires material. And that hasn't changed.
And again, the technology to 3D print certain portions of the home now exists. Again, it's not, scalable, it's very expensive,
Yep.
but no one has even talked about 10 years from now being able to 3D print windows, doors, roof
Yeah.
tiles, pipes. So,
How about
so I
cabinets?
mean, right,
Yeah.
exactly. How are you going to 3D print cabinets that people will actually like? Or what about, granite countertops? I think that what people have to understand is that we are over the next 10 or 15 years, we'll get to the point where the skeleton of the home can be 3D printed. But there'll still be hundreds of workers required for a typical home
To
for
do
all
the
of the things
finished
that
work.
cannot be do there's
Yeah.
3D printed,
Right.
and there's going to be no change in their costing. So I'm as excited as a technologist. I'm very excited about the potential of 3D printing, but I'm savvy about the amount of time that it takes to get there. And these things are very difficult. For example, the only company that has truly, 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 truly scaled this type of moving automation in the US is Amazon. So you see their warehouses and you see all those robots that move back and forth. And it's surprising to most people. It's like, oh, everyone should be doing this. The answer is automation is expensive.
Yeah.
And it's not only expensive to build, it's expensive to maintain. But Amazon, luckily, once it takes on a warehouse and has a 20-year lease, it doesn't need to move that warehouse. Well, the 3D printer needs to move every couple weeks.
Right. Yeah. Well, if it's building attractive homes, it needs to move to the next home. But yes, it needs to be disassembled, put on a truck, and moved completely, ultimately, to a whole new job site. I agree. I get it. And it's not a fair comparison when you look at a company like Amazon, because these tech companies, I mean, look, you're a tech guy, okay? They're so overfunded because we have this kind of winner take all
They do.
capital formation in this country, which I think is very wrong, by the way, but it's just the way it is, right? We have everything has sort of, even if it's not a tech company, it's kind of consolidated into I mean, show me another coffee shop that's not a Starbucks, right? There's hardly
Amazon
any
has to
choice
be a
in the
tech company.
marketplace. Yeah,
Otherwise, why are their PE multiples like a tech company, right?
right.
So to me, Amazon and Tesla are tech companies by the very virtue of looking at their price to earnings ratios, and they're
Hmm.
astronomical. Well, then they must be looked at that way. And I don't want to get into the whether that's right or wrong,
Yeah,
but I think that's the way that the world is looking at them. So
sure.
bottom line is, I mean, to get to the bottom line, real estate is extraordinarily difficult to disrupt. Technologists like me have looked at it for a long time as this is the place where we can make disruption. And it's not that we're doing poorly. I mean, from Zillow to Yardi Matrix to a
Yeah,
bunch of other companies, there's disruption happening. The
sure.
bits and bytes are being disrupted.
That's
I
easy to
think
disrupt. Yeah,
physical stuff, which is heavy, which has to be moved and has to be installed individually, is extraordinarily difficult. The other thing that is difficult is that the United States, by its very nature, is a country that gives its states an extremely large amount of autonomy compared to other countries, right?
sure.
And so, not only do we have 50 different states, each state has a county which has its own laws.
Right.
So, real estate operates under several thousand laws, and unless the Democrats and Republicans get together, no one's even talking about this, and spend a decade building a uniform civil code,
Yeah.
it's almost impossible to automate it in the first place.
Yeah, yeah, that's really a very good point you make about all of the laws governing it, and that's very hard to disrupt all of that. As profitable as investing is for me and my clients, it would be nice to end the housing shortage and really just make it more accessible, but I just don't know how that's going to happen. I
Well,
mean,
I know.
it has to be cheaper and
I'm going to put
easier to
up my
build
hand.
things and create
So
more
so
supply. Yeah,
I think the housing shortage ends in the next decade, and the
tell
answer
us.
for so the reason for that is this. No one that I have seen, with the exception of one person, her name is Ivy Zellman, so
I know Ivy
IVY
Zellman, yeah,
Zellman,
right.
talks about the fact that the demographics of the US, which were sharply positive in
Yep,
the 80s and 90s, turned sort of plateaued in the
yep,
2000s and have tanked in the 2010s.
yep.
And that, because demographics take so much time to impact the market,
And are
there's
you
no
talking
impact
birth
really
rate
today.
or household formation
Both,
age?
right?
Okay,
So we're talking about three pieces of it, right? And you
right,
just mentioned all of them. So first one's the birth rate, which doesn't affect us for the next decade, but affects us after that.
right.
The second, because the birth rate started dropping at the beginning of the 2000s, so it's really going to affect us in 10 years from now,
You've got to lag it
right?
by about 25 years,
Exactly. And,
25
and
to
then
30 years for
and
household
then you've got
formation.
household formation, right, which started to drop, a while back, and it's continuing to drop because of, exponentially growing costs of both the real estate and food, which basically makes people, form households later and later and later
Right.
in life, and we're seeing that impact now, by the way.
Hey,
Um,
Neil, avocado toast is more important than a house.
yeah, perfect analogy. I mean, this is what's happening, right? So when we look at demographics and how sharply negative the US's demographics have turned so quickly, we know that by 2030, the housing shortage, the numbers that I see for the housing shortage today are fairly credible. They're not exactly right. They're a little bit like inflation. They're a little overstated. But when I see the numbers by 2030, I'm absolutely convinced they're overstated because they're not taking this demographic shift in mind. And so I think that the housing shortage ends sometime in the 2030s because we're going to have an aging population, a lower birth rate, and we'll finally have caught up with that lower birth rate. So I do not think technology fixes this. I think demographics have fixed it already. We're just waiting to catch up with demographics.